Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the tax allocation in a consolidated balance sheet. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you're following along within OneNote, you don't need to have access to OneNote, but if you do have access and you're following along, we're on the tab 1039 in the problem presentations section. We're going to go over the full information for the problem, and then we'll pull pieces of that information as we work through the problem. Here we have the tax allocation to in consolidated balance sheet. That's going to be kind of a new thing we'll be dealing with. We're going to be looking into the tax effects here as we go through this process. We have the P, parent company, purchases a percent of S, subsidiary, common stock on December 31st, 2000, X5 at book value. So the purchased amount was 70%. Fair value of the non-controlling interest will be 30%. December 31st, 2000, X7, going to be the year of consolidation. P, or the parent company, has inventory purchased from S for 74,000. So that means P has the inventory on the books, which means S sold it to P. So we had an S selling to P, which is going to be an upstream transaction for the inventory. This is what remains on P's books. It has not been sold, is still in ending inventory. It's on the books at what they purchased it for, meaning what they purchased it from basically S for, the transfer price. And this is S's original cost, or the original cost of it. So we've seen these transactions before, this kind of intercompany inventory transfer type of transaction. And so we're not going to concentrate so much on just that process, how to deal with that transfer, as with the new thing here, which is the tax impact of it. So then we're going to go to S purchased inventory from P. So now we got the subsidiary purchasing inventory from P. So parent selling to subsidiary, that's going to be a downstream transaction. S's ending inventory. So now we got S's ending inventory, meaning what's on the books at the end of the year on S's books, which they purchased from P, which has not yet been resold, 89,000. That's what's on the books on S's books, meaning what they purchased it for. It was originally sold to them or P's original cost for it was 64,000. So then December 30th, 2000, X7, S sold machinery to P. So now we've got another intercompany type of transaction, this time with depreciable asset, the machinery being sold. So that's going to be for 98,000, purchase for 128,000, and the book value is 53,000. Company files separate tax returns and are subject to a tax rate of 40%. So we're going to be using 40% for our calculations. P, parent company, does not record tax expense on its share of S undistributed earnings. Okay, so now let's do our normal type of process. Let's think of our parent company, subsidiary company. This is going to be the trial balances for each for the time period that we will be consolidating. We're going to be adding these two up as is our normal process. So first, let's kind of get a recalculation or a rethought process of the equity method, and then how we're going to be allocating out the basically equity section of S. Now note, as we do this on these trial balances, we're basically just looking at the balance sheet side of things. So as we think about these tax effects, we're going to start off just looking at the balance sheet. So we will have journal entries, and whenever something's in the income statement, we'll basically record it to the retained earnings and see if that'll shorten things up and make things a little bit easier to focus in on the tax effects. So here, if we start off, we're going to say, all right, this is S's information, the assets minus liabilities, or simply the equity section would be for the 141,000 plus the 275,000. That's going to be the 416,000. So the 416,000 then consisting, of course, of that common stock and the retained earnings. If we then think about that being broken out in terms of the non-controlling interest and controlling interest, we would take that same 416,000 times the 0.7, that would be the 291.2, and the 416,000 times the 0.3, which would be the 124.8. That would be our standard kind of breakout. Let's now consider then the transactions, these intercompany transactions. So we have the current year transaction that took place. So the downstream transaction being this one. So this is going to be the one we're going to first concentrate in on here. So we're going to say, all right, the cost to S was the 89,000. And then we've got the cost to P is going to be the 64,000. So the difference is going to be that 25,000 gross profit that's basically in that ending inventory. If we consider the tax effect, which is kind of like the new thing here, we're going to be saying, all right, there's a 40% tax effect. So that 25,000 times the 0.4 is going to be 10,000. So after taxes, we have the 25,000 minus the 10,000 or the 15,000. So now let's do the same thing for the other transaction, the current upstream transaction. So now we're not looking at this one and are looking at this one. So the upstream transaction, we then have the cost to P is going to be the 74,000, the original cost 54,000, and the difference or gross profit being the 20,000. And then the tax effect is going to be that 20,000. Now this is the new thing times the 0.4. And so there's going to be the 8,000 here. Difference between the 20,000 and the 8,000, the after tax would be the 12,000. 12,000. All right. And then let's scroll on down. We're going to say then we have the adjustment to the basic consolidation entry. So typically our first entry has to do with the equity section, and for S, allocating the equity section. So we're going to make our adjustments to that for these intercompany type of transactions. And that's going to include some of the data that we just went through up top. So typically we have the ending book value, which is going to be the 124.8 and the 291.2. This is what we calculated first. So that's going to be these items up top. So now that's basically the equity section. That's going to be our starting point. Then we got the gross profit deferral net asset tax up. And this is going to be coming from the transactions we did up top. So this is the current year upstream transaction. We're taking that 12,000. That 12,000 I'm going to say is the total here. And then that 12,000 total is going to have a negative impact on this adjusting entry. We'll take the 12,000 times the 0.7. That'll give us the 8,004, and of course that 12,000 times the 0.3 will give us that 3,006. Then we're going to take the gross profit deferral net of taxes down, which is the calculation we did up top, the 15,000. So there's the 15,000. We're going to put that in the total column. Because this is a downstream transaction, it's only going to be allocated to P and not to the non-controlling interest. So we're going to keep it there. Now we're going to have another item down here that we'll see shortly, and it's going to be related to the sale of the machinery. So that's the other kind of intercompany transaction that we're going to be taking into consideration. We have the sale of the machinery, one to the other kind of intercompany sale here. So the sales, let's do a calculation of it. We had the sales price at the 98,000 given in our data. So it was sold for the 98,000 from one to the other. The purchase was for 128, so it was originally purchased for the 128. Then it had accumulated depreciation of the 75,000 to get to the book value of the 53,000. Now note the problem gave us the 53,000 and not the accumulated depreciation. So if we were to consider this, we could take the 128 and then the 53,000 and then back into the 75,000, which would have been then the accumulated depreciation. So then the gain is going to be the 98,000 minus the 53,000. That's going to be the $45,000 gain. The tax effect on that will then, of course, be that we're using just that 45,000. So we're going to take the 40%. 45,000, we'll use that too. But times the tax rate of 40%, and that's going to be the 18,000 tax. So then the after tax is going to be the 45,000 minus the 18,000 or the 27,000. That then is going to be our last component to this table up top that we're going to be including 27,000. We have the 27,000, which we are breaking out between the controlling and the non-controlling interest. So we're going to take that 27,000 times the 0.7. There's the 18,900, and we'll take that 27,000 times the 0.3, and there's the 8,100 that we'll break out here. Then, of course, we can add these up. Here's our original kind of first journal entry components, and then we've adjusted them to these bottom line numbers, simply summing up each of the columns. Okay, so then we have our similar kind of process down here. This is the same numbers we just looked at, same table, and we want to take a look at the deferral gain calculations, which basically we're taking the meat, the heart of this table here, and recalculating it down below. So we're just basically taking the heart of the table. So that's going to be then this. So we just basically took these numbers, put them down here, same numbers in the middle calculation, and then we're summing them up. So I'm summing up the entire row here, and there's going to be our adjustments. Okay, so now having that, let's consider our first journal entry. So now we've got the parent company, the subsidiary company as of the point of consolidation. We're going to be adding those up as is the normal process. Then we'll enter our consolidation or elimination entries into this column. This column will contain all entries up until and including the current journal entries that we are working on. So this will be the first transaction. Similar process as we've seen in the past. We've got the investment in S. We're going to come back to that in a second, but we're going to be pulling that from our table up top. Then we're going to have the common stock. So same process here. If we go down to the common stock for S, we're basically removing it. So here's the 141. It's a credit there. We're going to debit it to remove it. If we post that out, then we've got P's and then S's amount and then the total. We removed S amount with this debit, bringing us back to P. We're going to do the same thing for the retained earnings. So we've got the retained earnings here is on the books at the 275,000. 275,000 is a credit. We're going to remove it with a debit. Now, because we're just looking at the balance sheet, we're going to kind of combine the income statement accounts into it. There'll be some more activity that's going to be posted to this retained earnings account. So then we have the income from S. Income from S would be down here on the income statement. We're pulling that number, the 42,300, from our table up top. So we got the 42,300 that we would be pulling. We would be crediting that to our income from S on the income statement. It would then roll into the retained earnings and therefore is included in this number in the 221,000. Then we have the non-controlling interest in the net income. Again, income statement account number. We're pulling that 11.7 from the table up top, the 11.7 up here. That number then would roll into, on the balance sheet side of things, the retained earnings and therefore is included in this adjustment right here as well. Then we would take that and we're going to break that out between the non-controlling interest in NA of S and the investment in S. We're pulling these two numbers then from our table up top. So this was our starting equity position. Then we made these adjustments to this equity position, basically the 362. Then we're breaking them out between the controlling and the non-controlling interest. That 248.9 and the 1131 are what we are including here now, the 248.9 and the 1131. Posting this out, we've got the investment in S up top, bringing it on down to 0. We looked at the common stock. We looked at all these items already. Let's push on down to the next journal entry. So we have the prior journal entry here. Both the prior journal entry and the current journal entry we will be looking into are now included in this column. So they're already included in this column. So now we're going to be considering the intercompany transactions and the revenue related to the intercompany transactions. So in essence, if I scroll back up here a bit, we're picking up then the activity here from this 89 minus the 64, and then we had the 25,000. We're basically picking up these three numbers. We're going to reverse, in essence, the revenue for the 89, the cost of goods sold for the 64, and then the inventory for the gross profit that's included in the ending inventory of the 25. So scrolling back down, there's the revenue. So revenue's on the books as a, and note, we don't have the revenue accounts down here on the trial balance because we're going to post that to the retained earnings, but revenue would be on the books as a credit. So we're going to debit it. We've got the cost of goods sold, which would be on the books as a debit. So we're going to credit it. And then we got the inventory, which is going to be up top here. And we're going to basically reduce it by the 25,000. And so the new thing that we're going to have here then is also the tax effect, which is that 10,000. So the deferred tax asset then is going to be the debit here for the 10,000, and then the other side going to the deferred tax expense. Okay, so this is the new kind of component down here. We're going to, if we were to record this, because again, we don't have the income statement, we're just going to kind of shorten this up a bit. The revenue and the cost of goods sold would both be going to income statement accounts and therefore are included in the retained earnings account here. The inventory is included up top, so the inventory is included in this number, decreasing the inventory. Then we've got the deferred tax asset being up top in the asset section, of course. And then the deferred tax expense would be an income statement account, which also would roll into retained earnings. We're posting it directly to the retained earnings here. Okay, so then if we scroll back down, this is what we have done thus far. So here's the last one we just did. Now we're going to be moving on to the next entry, basically related to the inventory transactions. Let's pull those into place here so we can see them this time. So this is the current year upstream transaction. We're going to do the same thing. We're going to be reversing the revenue. So the revenue would be on the books as a credit. We're going to debit it to reverse it. We're going to reverse basically the cost of goods sold, which would be on the books as a debit. So we're going to credit it to reverse it. And then we're going to credit the inventory representing that has the gross profit basically in it. And that's going to be the $20,000. The new thing here then is going to be the tax component once again here. So we got the deferred tax added asset, which is going to be $8,000, which we calculated up top here. And then the deferred tax expense of the $8,000. So similar process. So if we were to record this out, again, these are income statement accounts. So anything on the income statement, we're simply going to record to retained earnings. That would include the revenue is going to go directly to retained earnings in our example, as well as the cost of goods sold included here. Inventory going down by the $20,000. So that's going to be up top included in this number. The deferred tax asset is going to be up top here included in this number. And then the deferred tax expense, also an income statement account that would then roll into retained earnings and is therefore included in this number. Then the next transaction we have, once again, everything we've done thus far, including the current 2 journal entries we just did last time, are included, as well as the current journal entry that we are working on in this consolidation entries column. This is and then we'll see the new transaction. This is going to be related to the gain on the sale of the depreciable asset. Now we can see its calculation as we did before is down below. So we did this calculation down below. So we're going to have to remove the gain. The gain is going to be this $45,000. So the $45,000 is going to be a gain that would be on the income statement, the sales price minus the book value, the $45,000. Then we're going to have the accumulated depreciation, which is going to have to go back on the books. And by the way, if you want to spend more time on this type of transaction, and get into more detail on it, you could take a look at prior transactions. Again, we're focusing here on the kind of the new thing, which is going to be the tax effect, which will be this $18,000 down below. So then we have the accumulated depreciation, which we'd have to put back on the books because we took it off the books when we had this intercompany sale. So it would go back up with a credit because it's a credit balance account. So we would credit it to increase it. And then the machinery would have to go back on the books. The actual depreciable asset would have to increase by that $30,000, even though there was a gain, because basically it was on the books at the $128,000. So $128,000, and it would be on the books now after the purchase at the purchase price of the $98,000 net, meaning it would no longer have the accumulated depreciation on the books of the purchaser. So then this would take that $128,000 minus the $98,000, and that's going to be our $3,000 that we're going to increase the machinery by. So then the new thing that we'll have also, once again, is we're going to have the deferred tax assets debit of the $18,000. So there's the $18,000 we're going to debit here, and then the deferred tax expense for the $18,000. Posting this out then, we would see that the gain is going to be on an income statement. Therefore, it's going to be included in the retained earnings as we're just looking at the balance sheet side of things. The accumulated depreciation will be up top in the accumulated depreciation, putting it back on the books with a credit, increasing that number. The machinery then is going to be included in the depreciable asset, increasing the machinery. Then we got the deferred tax asset included, of course, in this number. The deferred tax expense, then something that would be on the income statement, therefore rolling into the retained earnings and included in this number. So end of the day, we see that investment account has now gone down to 0 as would be expected. And we see the parent company basically equity section reflected in the total equity section over in this side. And then we have the deferred tax asset now on the books at the $36,000.